It's no secret that the ultra-wealthy play by a different set of financial rules. While the average person stresses over W-2s and tax returns, the rich seem to glide through tax season untouched, all while living lavishly. It's not because they're cheating the system, it's because they understand better than anyone else. Using a combination of legal loopholes, savvy investing, and strategic ownership structures, the rich often pay far less in taxes than the average person. Welcome to Luxo-Life, and here are 15 clever and perfectly legal financial rules that help the wealthy avoid unnecessary taxes and how they pull it off. 15. Leverage assets. Don't liquidate. Alternatively, simply borrow. Don't sell. Wealthy individuals often avoid selling their investments because doing so would trigger capital gains taxes. Let's say a billionaire owns $100 million in stocks. Selling even a portion would trigger millions in taxes. But by taking out a loan with those stocks as collateral, they get access to cash without creating a taxable event. This works because loans aren't considered income, so there's no tax liability. Better yet, the interest on these loans is often deductible, making the strategy even sweeter. All the while, the original asset continues to grow in value. It's a financial loop that allows the rich to fund luxurious lifestyles while minimizing taxable income. 14. Control without ownership. Own nothing, control everything. Wealthy individuals rarely have their names on the assets they use. Instead, they place everything from homes to yachts under LLCs, corporations, or trusts. By doing so, they protect themselves from lawsuits, limit estate taxes, and reduce visibility to the IRS. By not directly owning assets, they make it more difficult for courts or creditors to lay claim to their possessions. If something isn't technically yours, it's harder to seize, tax, or even trace. While it might appear that the ultra-rich don't own the lavish lives they live, they retain complete control just from behind a legal curtain. 13. Erase taxes with the step-up in basis. One powerful tool wealthy families use to preserve generational wealth is the step-up in basis rule. When someone dies, their assets receive a step-up in basis, meaning the value of those assets is adjusted to their current market value. If the heirs then sell those assets shortly after inheriting them, they often pay little to no capital gains tax. Because the gain is calculated from the new stepped-up value, not the original cost. This is a massive tax break for wealthy families. Instead of selling assets and triggering taxes during their lifetime, they pass them down. In doing so, they erase decades of appreciation and the tax bill that would have come with it. 12. Turn lifestyle costs into business deductions. Owning a business opens the door to a wide range of legal tax advantages, and the wealthy know how to make the most of them. Business owners have access to one of the richest tax strategies in the world: deductible expenses. Wealthy individuals structure personal activities as business related to write-off costs legally. Vacations become business retreats. Luxury vehicles are company cars. Fancy dinners, client meetings. Even their homes may be partially written off as rental properties. By running personal expenses through a company, the rich reduce their taxable income while still enjoying their lifestyle. 11. Build wealth silently with life insurance. Most people think of life insurance as a safety net to protect their loved ones, but the wealthy use it as a tax-sheltered investment vehicle. A specific type, called private placement life insurance (PLI), allows investments to grow tax-deferred inside the policy. When the policyholder dies, the death benefit, which includes the appreciated investments, passes to heirs tax-free and without going through probate, keeping the transfer both efficient and private. It's a discreet, effective way to transfer massive wealth while avoiding estate and capital gains taxes. For the rich, life insurance isn't just about protection, it's a financial fortress. 10. Turn paper losses into real tax savings with depreciation. One of the most powerful and misunderstood tax advantages in real estate is depreciation. Buildings lose value on paper every year, even if they're actually appreciating. This paper loss doesn't reflect actual market performance, but it can significantly reduce taxable income. For wealthy investors, this means their rental properties may generate strong cash flow while appearing to lose value on tax forms. It's a fake loss that delivers very real savings. The result: more money in their pockets and less in the IRS's. 9. Donate smart. Give assets, not just cash. Giving back is noble, but for the rich, it's also strategic. Instead of donating cash, they often donate appreciated assets like stock. This allows them to avoid capital gains taxes and take a deduction for the full market value of the donation. They might also use donor-advised funds, which allow them to get the tax deduction now while distributing the money to charities over time. This makes giving not only generous, but also tax efficient. 8. Centralize wealth management with a family office. For ultra-wealthy families, managing large sums of money isn't left to chance. It's run like a business. A family office is a private wealth management team. Lawyers, accountants, financial advisors, and tax professionals dedicated to one wealthy family. These offices manage investments, estate plans, taxes, and more, all under one roof. By centralizing these services, family offices provide better oversight, higher efficiency, and optimized tax strategies. While most people juggle multiple professionals, the rich build an in-house financial brain trust. 7. Reap rewards by investing in opportunity zones. To encourage investment in struggling communities, the U.S. government created opportunity zones, geographic areas, where investors can receive substantial tax breaks. If an investor rolls capital gains into an opportunity zone project, they can defer and potentially reduce the taxes owed on the original gains. Hold the investment for at least 10 years, and any gains on the new investment are tax-free. It's a win-win. Rebuild communities and shrink your tax bill at the same time. 6. Shield wealth with trusts to avoid estate taxes. Wealthy individuals commonly use irrevocable trusts to shield assets from estate taxes and protect them from lawsuits. By transferring assets into a trust, those assets are no longer considered part of the taxable estate. Despite relinquishing ownership, the grantor can still control how the assets are used and distributed. This keeps wealth in the family for generations while sidestepping one of the most punitive taxes, the estate tax. 5. Turn losses into future tax savings with carry-forwards. Every investor has bad years, but the wealthy know how to turn those into future savings. The IRS allows carry-forward losses, which means losses from investments such as stocks or real estate can be carried over to offset taxable gains in future years. So if a millionaire loses $500,000 in the market this year, they might use that to lower taxes for the next several years. These paper losses become a tax-saving asset when the next big investment hits. 4. Minimize global taxes with offshore entities. The ultra-wealthy often structure ownership of assets through offshore corporations in countries with favorable tax laws. These entities can reduce or defer taxes on foreign income and provide additional privacy protections. By layering ownership structures and placing assets in international jurisdictions, the rich legally minimize their global tax exposure. It's not about hiding wealth, it's about placing it where it's taxed least. 3. Turn art into a tax-advantaged asset through an LLC. Art collecting can be a hobby or a highly strategic tax play. Wealthy individuals often purchase fine art through an LLC or corporation rather than in their own name. This allows them to classify artwork as office decor, defer taxes on gains via special like-kind exchanges, and even store pieces in free ports to avoid import duties. In their hands, art isn't just beautiful, it's a mobile, discrete asset class with unique tax perks. 2. Defer taxes on real estate profits with 1031 exchanges. The 1031 exchange is a powerful tool in real estate. It allows investors to sell a property and reinvest the proceeds into another like-kind property, all while deferring capital gains taxes. This strategy can be used repeatedly, allowing real estate portfolios to grow over time with minimal tax friction. It's how the rich flip properties and roll profits without writing big checks to the IRS. 1. Generate tax savings with passive losses from syndication. Real estate syndication are group investments that often generate paper losses through depreciation and operating costs. These losses can be used to offset other income, even W-2 income, if structured correctly. High-income earners use these losses to reduce their tax burden, all while investing in cash-flowing real estate. It's the ultimate combo: passive income, paper losses, and lower taxes. The bottom line: own nothing personally. At the heart of all these strategies is one key principle: own nothing personally. Control everything. The wealthy have mastered the art of using structures like LLCs, trusts, and holding companies to hold their assets not in their own name, but in entities designed to protect and optimize their wealth. For example, luxury cars may be registered to businesses, homes placed in trusts, stocks held in shell companies, and even private jets owned by separate corporations. On paper, it might look like they own little, yet they control vast empires of assets. The goal isn't to hide from taxes, but to structure wealth in a way that is deliberate, protective, and tax efficient. Conclusion: the wealthy don't avoid taxes because they're lucky or dishonest. They do it because they understand how the system works and they play the long game. These financial rules aren't secrets. They're tools available to anyone willing to learn and act strategically. While not all of these strategies are accessible to the average person, understanding them is the first step toward building smarter, more resilient wealth. Whether you're a budding entrepreneur or an investor in the making, remember this: money flows where strategy goes. Which one of these would you considering taking up as a way to reduce your spendings on tax? Let us know in the comments below. And if you like this video, don't forget to thumbs up and subscribe for more content like this in the future. Until next time.